Interest. The marketplace doesn't seem like it is that interested, though. We have the S&P 500 index trading down about 7 points today. We'll call that flat, considering for the first time ever in the U.S. Congress, we had the Speaker of the House ousted. And we have huge budget talks going on and trying to decide exactly what the budget is going to be. We talked a lot on Monday about the fact that the government was able to kick the can down the road and give us about, well, now it's going to be 43 days to try to come up with a budget before they will shut down the government. A lot of people were disappointed in that. No idea why. So they just decided to fire the Speaker of the House. So I don't want to get into the politics by any means, but that's what happened. I thought the marketplace would react a little more strongly to the downside on this scenario. But I guess we're not closer to the date, right? The big deal is really the budget talks and trying to make sure that the government doesn't shut down and essential employees actually do get a paycheck at the end of the month or week or whenever they're supposed to be paid. And so we did an SPY short call spread on Monday. And basically saying that until this gets resolved, I don't really see anything. It's hard to get bullish on the marketplace. It's hard to get bearish on them. It's hard to do anything in the marketplace until these issues get resolved. The Fed Watch tool has been all over the place as far as November is concerned and the possibility of a quarter point rate hike. And it's now trading right around, the futures are implying about a 25% chance of a rate hike in November. That's been as high as before the last Fed announcement. It was as high as around 40% chance of that rate hike happening in November. Came tumbling all the way down to about a 12% chance. And now we're somewhere in the middle, about a 25% chance. And it has a lot to do. The government shutting down would definitely damper the need for another Fed rate hike. Without a doubt, it would hurt the economy immensely. And so I until we get that resolved, there's really nothing that the Fed can do. There's really just that will no longer be the main headline if we're going to raise rates or not raise rates as far as the Fed is concerned. And so let's start by looking at what we had going on in the SPY, and let's look at a couple of charts. So I'm going to start by, right now we see the SPY is trading at 421.38. It's down just a fraction. But if I look at the chart over here, we got the VIX index. Well, here's what happened with the VIX index. Let me do that before I go running over to the SPY, because we took off our trade on Monday. And in hindsight, we could have stayed long the trade, or we sold a put spread to buy a long call. We could have stayed long the call. And our target was right around 20. And we did get the VIX to come up to that level. It did breach the 20 level, and now it's trading down a little bit more. I'm not really sure why it's trading down a ton. Still think there's a lot of nervousness in the marketplace. And you can see that nervousness is finally showing up in the VIX. But I still think it was the right move to get out of the trade, because we were trading on the one event, the event that there was a potential shutdown in the marketplace. You could have said it was for speculation. You could actually just said it was portfolio protection to get long some VIX call options and selling some puts, actually a couple of put spreads to buy a couple of out of the money call options. The marketplace, that event was a non-event. And now we see the VIX still trading right around that 1920 level, showing that there is nervousness in the marketplace above the 200-day moving average, which is really kind of a line in the sand. That's usually where the marketplace wants to come back to. We see that if we run up and touch the 200-day moving average, this is the smaller moving averages, but it's pretty hard sometimes for the VIX to actually break out to the upside on that. But it really depends on, well, obviously major news events really is what drives the VIX index. So if you look at the SPY, there in the SPX, I'm going to pull up the SPX, and that's how we'll look at this trade. The 200-day moving average is a big deal, and I do think right around the 4,200 level is 4,230, right where we're at. And this is the 200-day moving average below it. Usually provides some decent support in the SPY. So I just decided to get kind of fun with our paper trade that we put together on Monday. And I did hint on Monday that, it might be a time to do an iron condor, which is we sell a call spread and we sell a put spread, and we hope that between the short options is where the marketplace stays. And I'm going to show you that. So give me 1 second. I'm going to run over to the options playbook. I haven't brought it up that often, but it's optionsplaybook.com. That's the companion website to my book. And we're going to take a peek at the options marketplace. So here we go. Here right now, this is what I was showing with the Fed meeting. It's a 23% chance that they're going to raise the rates from where they're currently at up 0.25 percentage point. If we look at the options playbook, which is optionsplaybook.com, we're going to look to put on an iron condor. So the trade that we're going to add today is a short put spread because we've had the marketplace come down. We brought in a small credit from doing the short call spread. My intention when I put on the trade on Monday wasn't to leg into an iron condor. A lot of times I prefer to do it all as one trade and not have that market risk. But I thought it'd be interesting to talk about it considering what has happened in the marketplace. As I said, there's a lot going on in Congress, and that's really what's driving. You get some economic numbers. The consumer's still resilient. The economy's still kind of hanging around. The market's kind of hanging around, but the marketplace has nowhere to go. It has no idea what the next step is going to be because they're all waiting on the news to come out of the U.S. government. So, short call spread. If I do a short call spread, I'm selling strike A out of the money relative to where the underlying is at, and I'm buying strike B. And on Monday's show, we did that, and we brought in a net credit of 52 cents. And I'll show you where that trade is in the SPY. Now we're going to look at doing a short put spread. That will be the paper trade today. So the short put spread is the inverse of the short call spread. It's a bullish trade that wants the market to go up. So I'll just flip back and forth between the strategies here in the options playbook. We're going to go short call spread, saying from strike A on up, we have risk. From strike A on down, we don't. That's our sweet spot in a short call spread. Short put spread from strike B on down, then we're using puts. This is where our risk is. From strike B on up, that's where our sweet spot is. So we combine the two, and we come up with an iron condor. Okay, so here's strike B on the put. Here's strike C in the options playbook, which is the call. And we want the stock to stay within that range. So it behooves you, obviously, if you put on the short call spread and the marketplace goes down, and then you can put on the second half of the iron condor and do the short put spread. And I don't mind this trade because of where the marketplace is at. So if I look at where the chart is in the SPX and the SPY, I think we're going to get a little bit of support around that 200-day moving average. I don't mind putting on another trade, just something so that we can watch in this marketplace. I don't know what else to do in this marketplace. It's not an exciting marketplace to get long. There's always a bull market somewhere, but I don't necessarily want to get long the market. And I mean, if anything, I would lean to getting short. We already looked at that short call spread, and I don't mind doing short call spreads in a lot of things. On Friday, we're going to come back and we're going to look at a very basic strategy on Options Guide TV, and we're going to talk about protection. We're going to look at protective puts. We're going to look at cashless collars on stocks that we might own, and maybe even a put in an index. So we're going to focus on using options, what they were first intended to do, to try to protect positions. But today we have our short put spread on already. So go back to that. Or our short call spread on already. We're going to go back and do our short put spread. And we're going to roll that into our iron condor. Oh, iron condor's down here. There we go. And so let's get that started. So I'm going to switch my screen here for a second. Let's go back to the TradeHawk software and get to the options grid. Okay, so here's the SPY. The expiration that we used was the November 11th, November 3rd expiration. We have a lot of expirations here. So we still have 30 days remaining in that trade. We went out, and I'll put on the short call spread to start with. We sold the 450 strike, which is now further out of the money. So we sold this strike right here, which I'm going to click on the bid to put that down below, 450. And then we bought the 455 strike, which is right here. Okay. That we did for 50 cents, and now it's trading for around 26 cents. So almost made half of our premium. If I put this trade on and I could buy it back for 10 or 15 cents, I would probably take it off, especially with 30 days remaining to the expiration date. If I could get it for 10 cents, I'm definitely going to do that. Trying to extract that last 10 cents of premium out of a short call spread is extremely hard to do, especially in a $421 underlying, an expensive underlying. Takes longer for that time premium to erode. But instead of that, since we're close to that level, I am going to look at selling that put spread. Okay, so when we put this on, we were about a 1 standard deviation move out of the money. We're looking for about 50 cents. It's going to be a little bit harder on the put side of things to get 50 cents just because of the way volatility works. There's usually a skewing. Further out of the money, you pay a little bit more for the put, so our protection will be a little bit more expensive. So we're going to go down to the 398 level. Let's look at the 400. Let's look at that one. I like that level right there. 420 is about where that 200-day moving average is at. We are going to then sell the 400, and we'll go down 5 points. We'll make this very simple, and we'll buy the 395. Okay. And that would be how we would leg into our, let me grab this if I can. No, I got to adjust that. But let's put it in the what if calculator is what we'll do. And that is how we would adjust our short call spread into a iron condor. We sell the credit spread on we're using calls that is neutral to bearish on the marketplace. And then we go in today after the market has been down, and we're going to sell the put spread that is neutral to bullish. And this outlines inside the what if calculator where our sweet spot would be on this butterfly. Now, the what if calculator is assuming that we're going to sell that short call spread for the 25-cent credit. We already know we did it for a 50-cent credit, but that's what it's assuming. It's using today's marketplace to lay out this strategy. But by doing this trade, I'm still going to keep the concept on that if the short call spread gets down to around 10 cents, then I'm going to remove that and take that trade off. That would mean that the marketplace is going the wrong direction on our short put spread. And that's what's interesting about an iron condor, is that it's something you are probably going to adjust this trade in some way, shape, or form. Some people can just put them on and say, if I ever get to a short strike, that's when I'm going to take off that leg of the iron condor. So this, obviously on the call side, would be worth next to nothing. When we get down to the put side, especially if it ever gets down to my protection strike, I'm going to get out of it. And it always depends on where you're at as far as expiration is concerned. But this is the trade that we're looking to put on. Let's see what type of credit that we can get on our short put spread. So let me remove the call side of things, and that will slide everything up a little bit. And well, we were looking for 50 cents and we got it. And that's mainly because we didn't quite go a 1 standard deviation move out of the money. These are the put sides on the Trade Hawk options grid. We sold the 400. The high with the grid highlights the 1 standard deviation move, and that also is kind of highlighted by, that should be around a 16 delta. So we're right in between these numbers somewhere. And the fact that we could get that off for a 50-cent net credit to my account, I like that. It even makes me like this trade a little bit more. I still think that the marketplace is just going to be in doldrums, deciding what the marketplace is going to do until Congress acts. Now we got another little cog in the wheel. Who's going to be the speaker? And there's going to be a lot of conversations on that. Not a lot of people are going to be paying attention to the market. I suppose if you have money in the market, you're always going to pay attention. But a lot of this focus is going to be on what's going on with Congress and how they handle things. I like that 400 level. I could see just putting this short put spread on along with just in general. Just let's say we didn't have a position in on the short call side. We could do the short put spread to go along with it. And that's what Options Guy TV is all about. We're just trying to look at conditions in the marketplace and apply one of the 40 strategies inside the options playbook to the current market conditions. And so we don't talk about a lot of iron condors here. We're kind of looking at stocks a lot. I do like the iron condor. It's just a very boring trade, right? You're selling it, bringing in a little bit of premium, hoping the market doesn't go anywhere. And then you're taking it off and paying hopefully less premium than you received when you put that trade on. So it's a strategy that people like to do over and over again. And actually, the way the marketplace has been over the last year, we've had some volatility with some predictability. We've gone into bullish periods, but it always seems like the market has retracted and came back. And it's really been trading in this range between 4,100 in the SPX and 4,400. So the iron condor trader has probably done really well. Obviously, depending on the duration that you're putting on, and every once in a while you might get forced out of one side of your iron condor. But with that said, this has been a trade that's been interesting to do in the marketplace. At the end of last year, iron condors were very interesting. So that just highlights the fact that there is no golden book of answers when it comes to what is the best strategy in the options trading world. And I do see that we have a question here. So let me run to the question. To calculate your rate of return for this position, would you do it on each individual wing, or would you combine the entire position's margin requirement? Okay, so the margin requirement is actually something that needs to be talked about. So when we sold the short call spread, we were 5 points wide. That means that your brokerage firm, if it's Tradier, will hold out $500 or for every 1-by-1 spread that you do. So the maximum risk of that trade is $5. So that would be $500 on that short call spread. Now, here's the benefit of the short put spread. And so I really appreciate that question, because I wasn't going down this road, but we can put on that short put spread with no additional margin requirement. Why, you say? Well, the market can't be in two places at the same time, right? The market can't be down below our short put strike and up above our short call strike. So because the market can't be at two places at the same time, there's only one margin requirement. So putting on this short put spread, as far as margin is concerned, this would be free. But that also means that if you do calculate your return on investment, let's say you did make the maximum on this trade, which if we get this done for, we'll put it at, that's 51 right now. We'll leave it at 53. So at 53 cents, and then I think the other trade that we did was about 52 cents. So let's just call it $1. So if you made $1 on your trade, you have to look at the margin that you have up on that trade, which would only be $500. And I only say only, and I only use that word because you're doing two short spreads, and you just have to put up the margin on one side of it. So it would be, I could bring in a maximum of $1. The maximum that I had to put out for that trade was $500. And that would be the, that's how I would do my return on events on this investment. $1 could be potentially made with $5 of margin that we put up, 20%. So a very interesting time. I think it is the right time to start talking about iron condors. And you could take this and just say, well, I don't mind doing a short call spread. The fact that that call spread came down to 25 cents, which isn't quite where I'd want to take it off, you might want to consider just closing it out and rolling again. I just don't want to be in any short trades, anything that's short the market, when the budget talks come again. We'll probably look at another trade in the VIX, especially if we saw what we saw before. So to highlight the VIX, when we put on our VIX trade on the Friday before that magic Monday of the new budget announcement, the October 1st, we saw the VVIX, and I'm going to point to it right here on the option screen. So let's go there for a second. We saw the VVIX trading at 88, and now we're up to 102.50. So that really helped out our long call side of things. So the VVIX is the VIX of the VIX. It implies that the VIX option contracts are going up in implied volatility. And then we saw the VIX was trading right around 16, which I really thought was amazing. I think it was 15, actually. And now we see it trading at around 19. And that news has already gone by, and they've already kicked the can down the road. But then we had the additional news of what's going on with the speaker. And so there you have it. We're trading at that level. If we did see the VIX come back down going into that big major announcement, I would go back and do that same trade again. And we jokingly called it the Russell Rhodes, the RR, which we had Russell on our show not that long ago talking about that trade, who has written a few books on the VIX and is a great resource if you ever need to know anything about the VIX index. Okay. So at this point in time, if you have any other questions, we want it to be a very interactive show here on Options Guy TV. So if you are on YouTube, please feel free to put them in the chat box, and I'm happy to address them. And if not, if we don't have any other questions, then that's going to be it for this edition of Options Guy TV. Please click subscribe, ring the bell to make sure that you get all of the alerts as far as Options Guy TV is concerned. And then pound that thumbs up, and we'll see you this coming up Friday to talk about protective puts and protective collars in individual stocks. So this Friday, 11 a.m., we'll see you for the next edition of Options Guy TV. Thanks for coming, everyone.